Hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about inflation and interest rates, two really important areas of retirement income planning, whether you're getting ready to retire in the next few years or are already retired. Now, inflation's all over the news. You've got to buy gold and silver and commodities, and what are you going to do to cope with inflationary impacts? So I'm going to talk about a couple of studies that have come out recently by two well-respected asset managers that we use for client retirement portfolios. So we'll cover that in a second. I've got a calculator that we use to help clients model the impact of inflation, and that provides guidance on how to organize their financial planning to cope successfully over the long term against inflationary impacts. So you'll enjoy this installment. Now, if you're new to the channel, make sure you hit the subscribe button. Posting content all the time on different aspects of retirement income planning. And make sure you hit the notification bell so you're alerted to the content that gets posted. Okay, let's take a look at the calculator, first of all, that we use to help clients on their own time just kind of model the impact, and then that's a good fertile ground to begin exploring how to cope with those impacts in your own planning. What I've done for this calculator is I've simply just used a number of $75,000 per year. This is pre-tax income in my example. We're using a 25-year period, and we're using an inflation rate of 2% per year. So, inflation's around that right now. So let's assume that inflation averages that over this time period. You can see that at a 2% inflation rate, that $75,000 per year of income need is now grown to $123,000. So not quite double the costs over that extended time period. So you can see that if you've got somebody who's retiring at age 60, by the time they get to age 85, we're seeing a pretty significant increase in costs. So when I work with clients, one of the things we need to contend with is building models that integrate the impact of inflation, and then what strategies we need to utilize to cope with inflation. It could be a combination of investment strategy. It could be a combination of sustainable cash flow planning strategy. So there's various things to take a look at when you build the model. But the first thing is to kind of acquaint yourself with the impact. So on your own time, go to the calculators, go to this one to see, okay, if I look at the next 10 years of my retirement, how much money do I need to be generating to cope with inflation so I have real purchasing power that's maintained. So make sure you take a look at that. So the first thing that I'm going to share with you is some research that was put out by Vanguard in March 23rd of this year, and they're sharing their perspective on interest rates. Now, it's important that we put our ear to the ground on this information because it does have an impact on how you approach your portfolio or how your advisor is going to approach the portfolio that you have in place. We're using Vanguard and US data on this particular research piece. Another one I'll show you comes from Canada. Why the US? Well, central bank policy in the US has a ripple effect through the whole planet. So it's important that we pay attention to it. Why pay attention to Vanguard? They're one of the largest asset managers on the planet, managing about $8 trillion. So when they have a perspective on an issue, I think it's important that we pay attention to that perspective. Now, one of the things that they talk about, which you may or may not be aware of, is that the Fed's gone from sort of this fixed focus on a 2% rate in terms of when they begin to intervene around inflation. And they're now using an average inflation rate, which is a bit of a departure. So it gives the Fed a little bit of wiggle room in terms of how quickly they respond to inflationary pressures in the economy. I'll talk about in a minute why that's important. So the Fed rate outline changes. They outline changes to its monetary policy framework that give us, that's Vanguard, confidence that it won't raise its benchmark federal funds rate target until at least 2023. So from their perspective, they think interest rates will remain low for the next couple of years. And this is even with stimulus payments flowing into the economy. They go on to say in this report that we expect economic outcomes to start changing with inflationary pressures rising and unemployment falling. So they do think that there's going to be an evolution here as we go more and more to full employment and the demand side for goods and services continues to go up. There probably will be some inflationary pressures. Now, if you go on to look at some of the other information on this report, I think this is worth going through together. The current Fed Chair, Jerome Powell, has made clear he is also seeking improvement in areas that are typically late to recover after recession. such as labor force participation among workers without college degrees, wage growth for the lowest paid workers, and black unemployment. Powell's Fed wants full employment to reflect the full labor market, and rate hikes may not come until it clearly does or will reflect that. So they really do want to see a broad improvement in the labor market before they begin intervening and raising interest rates to curb inflation. Now they go on to say, what about the Fed's rationale for patience in relation to inflation? The Fed made an important change to its approach last year to help anchor inflation expectations. It changed its inflation target from specifically 2% to an average of 2% over time. So it's very important. So an average of 2% over time. Such a change has been anticipated as core inflation has been below 2% for so long. So again, they think that what's going to happen, this is the Fed, is that the demand side of the economy, which is going to come roaring back this year, will definitely put price inflation pressure on goods and services. But they feel that the long-term structural impacts of COVID are such that you'll see this impact of inflationary pressures and then the impact diminishing. So they don't feel they should be intervening right away to raise interest rates in a situation where they think average inflation over the next little while is not going to move too much above that 2% range. So it's a really important policy change. So for you and I, that means that the expectation is that likely the Fed's not going to change interest rates in any meaningful way. Now, the Bank of Canada will likely take its cue from the Fed's policy approach to inflation. Now, what I'd like to do is just give you a very quick overview on a chart that Vanguard embedded in this report. So the chart was called Tight Labor Markets Haven't Recently Triggered Worrisome Inflation. Now, the reason that's important is that wage pressure and tight labor markets, which leads to wage price pressure increases, can be very inflationary. It's one of the key components to inflationary pressure is wage increases. And over the last number of years, we haven't seen that. So let's go through the chart. The chart goes from 1960 through to 2020, and the black line is basically unemployment numbers, and when that black line kind of hits that solid line right across, that's full employment. So it kind of zigs and zags back and forth. Prior to the COVID crisis, the U.S. economy, as an example, was right in full employment zone, and it's been there for a while. The interesting thing is what that full employment led to in terms of price hikes. We've got something called the Personal Consumption Expenditure Index. That's the green here. And typically what you see is the green pricing pressure goes up and down relative to economic cycles. So if you see a recession, unemployment levels increase. And when you see expansion in the economy, unemployment decreases. And you see inflationary pressures. But for the last number of years, we haven't seen that. And there's two main reasons for that. Number one is globalization. So U.S. companies outsourcing the delivery of products and services or manufacturing of goods to other places in the world where the cost of labor is much more competitive. The second thing is technology. Technology has profoundly impacted the cost of delivering goods and services to the consumer. So those two things have helped to keep a lid on pricing changes in terms of labor costs. Even though the labor market was tightening, we weren't seeing very much in the way of cost increases. Now, the Fed believes that that trend will continue. So if we look at the 2020 COVID situation, you can see we had a massive spike here in unemployment. And now it's come down quite a bit, but we're still nowhere close to full employment. So if you're looking at interest rate policy, you probably won't see a lot of intervention until we see that black line come down further. But the Fed still believes that technology, and it may be even more profound today post-COVID, and globalization and trade will keep a lid on those costs. So that's one of the reasons why they're not going to intervene right away. Now, in saying all that, we still live in a world where there is some inflation. Even a 2% inflation rate has an impact over time. So what are the takeaways in your own personal planning? First thing is, start noodling around the impact of inflation in your own plan. If you're getting close to retirement or you're already retired, what is the impact over the next 5, 10, 15, 20 years on your purchasing power? You want to take a look at our coaching service. I've got a link in the notes with this video that'll take you to our forecasting models. Those models are really powerful because it allows you to demonstrate what those costs will be down the road and what pressure it's going to put in your portfolio to cope with those increasing costs. It's a combination of the return you need and how much you're spending. And you want to know that as much as possible before you retire, before you embark on an aggressive expenditure plan for retirement. So one of the strategies is to deaccumulate or take cash flow from your portfolio in a way that helps you maintain your lifestyle, for sure, but at the same time preserves enough value that you can cope with increasing costs down the road. The other is to make sure you've got assets in your portfolio or your balance sheet that have typically been good protections against inflationary pressures. Just even good blue chip stocks or equities in your portfolio do that. Companies ultimately pass on inflationary pressure, right, through the increasing costs of their services. So you want to talk to your advisor first, do the analysis. What kind of pressure is being put in the portfolio? Do you have sufficient assets to cope with that pressure? If you don't, you want to make sure you're introducing assets that are inflation proofing. And that's a really, really important discussion to have with your advisor. Again, we have a link to our retirement coaching services that talk about that in detail as well. Anyway, I hope that you found this discussion helpful, and make sure you hit the subscribe button so you don't miss future content. Hit the like button if you enjoyed this video. You take care. Bye-bye.